Hey everyone, thanks for tuning in to our April 2026 Investment Committee update. I'm Chad Smith, a managing partner at Reveille Wealth Management and part of our investment committee. Today, Stephen Weitzel and I are going to share our latest market perspectives and how we use our rules-based investment discipline to inform the current positioning within our investment strategies. Stock markets around the world recovered in April following ceasefire talks between the U.S. and Iran. The commodities complex and bond markets are seemingly less convinced with the progress being made, with oil prices and interest rates remaining elevated. Within U.S. equities, April was a very strong month for technology stocks, which had been market laggards through Q1. Year-to-date, market leadership groups such as energy, utilities, consumer staples, and materials were mostly unchanged in April, despite gains at the headline index level. As Stephen will review, we are still seeing evidence of a longer-term rotation into international and emerging market equities, and within the U.S. into more value-oriented areas outside of just technology. In the aftermath of the surge in energy prices, we would expect a series of inflationary shocks in the coming months. The University of Michigan's Consumer Sentiment Index has dropped to a record low on concerns around employment, a resurgence of inflation, and geopolitical conflicts. The Federal Reserve held interest rates steady at their April meeting, but despite Kevin Warsh being on the doorstep of leading the FOMC, the bond market may now be preparing for interest rate increases in the future. So I'm now going to turn it over to Stephen to take us through this month's review.
Okay, thank you so much. So we're coming to you live from the Raymond James Elevate Conference, which is the national conference they put on every year. We're out here in Las Vegas meeting with other financial advisors and industry professionals, but wanted to take the time here to be able to bring you our monthly update. So let's jump in. Now, on the heels of ceasefire talks between the U.S. and Iran, markets rebounded in April. On the surface, it was one of the strongest Aprils in market history for the S&P 500. Stock markets came out of the red year to date and are now positive for the year. But the real strength underlying the rebound in April came from the technology sector, which had been a material laggard in 2026. In fact, the strongest sectors in the U.S. equity market through the end of the first quarter, energy, materials, utilities, and consumer staples, they were little changed for the month. But despite not participating so much in April's advance, they each still lead the broader index for the calendar year. Bonds struggled for the second month in a row as concerns about higher and stickier inflation persist the longer this geopolitical turmoil lasts. Now, over the last few months, we've discussed how the diversifiers within investors' portfolios have started to do the heavy lifting, and the S&P 500 has really become an underperforming asset class. These trends continue to roll over in favor of these alternative investment categories. The visible exception here really lies, though, with the S&P 500 versus the developed international index, which has bounced in favor of U.S. stocks over the last month or so. I would suspect, however, that this ratio will continue to resolve lower in favor of foreign markets, as that seems to be the common theme with these other alternative asset classes. Now, in Jerome Powell's last meeting as the chairman of the Federal Reserve, the committee elected to hold interest rates steady. We did see 4 dissenting votes at this meeting, however, which is the first time in nearly 35 years that there has been so little consensus among voting members. One of the dissenting votes was to lower rates at this meeting, while 3 others disagreed with language in the statement that alluded to a desire to reduce interest rates further in the future. Now, if you've been with us for a while, you'll recall that we have not really shared the Wall Street consensus expectation for a series of additional rate cuts in 2026, regardless of who's chairing the FOMC. We believe that the front end of the U.S. Treasury curve is really the best barometer of future Fed policy, and those rates have been holding steady for at least the last 6 months. This chart here shows the yield on the 12-month Treasury bill. So if there was a reasonable expectation that the Fed was going to be lowering rates, we would see the yield on this trending lower towards 3 or 3.25%. But if we start to see it move above 3.75 or even up towards 4%, that would really be a tell that we would have potential rate hikes coming in the near future. Now let's move on to the charts. Last month, when we looked at this chart of the S&P 500, things were pretty gloomy. The S&P had broken the uptrend that had been in place since May of 25 and was starting to head lower. But lo and behold, in early April, the market stopped going down and did a complete 180. At least that was the case for the largest companies within the index, the technology stocks, which, like it or not, they're going to heavily influence the direction of this index. Now, as they rebounded, so too did the index, and sufficiently enough that the S&P 500, it's not in a downtrend anymore. If you'll recall from our review last month, as defensive as we had become, the mantra that we shared repeatedly with respect to a number of these asset classes was, if we are above these former highs, we want to be invested in this space. But if we're below that, we want to be out. Well, U.S. mid-caps were a really good example of that. We're still in an uptrend here, but we were trying desperately to stay above these former highs from Q4 of 2024. And you know what? They held on. So mid-caps remain in an uptrend. And so that the bull-bear battle took place right here at these former highs. And for right now, the bulls are winning. Small caps is a very similar story. The Russell 2000 index was nearly triggering a sell signal per our discipline, but it was also retesting those former highs from October of 21, Q4 of 2024. And so as long as we are above those former highs, we can be comfortable owning small caps. Below that, we're going to want to be out. Now, this chart's even cleaner than the mid caps that we just saw. We retested those former highs, and right as we're retesting that uptrend line from last May, and we have bounced higher. Now, even though the nature of our reviews here is looking at charts and identifying primary trends in markets, I want to throw in a fundamental economic comment here. We've been talking about this rotation away from the S&P 500 for a while and how we want to own more small cap U.S. stocks than we would have previously allocated in the portfolio 10 years ago. But you might remember this chart that we saw as part of that 4-quadrant slide earlier, where we see this ratio of the S&P 500 versus the Russell 2000 rolling over. Well, that's happening at a logical level. It's happening at the same level where small cap U.S. stocks bottomed relative to their large cap counterparts back in 2000 at the peak of the dot-com bubble. But I think there are some really strong parallels here to the internet era, and we've talked about them in some of these reviews before. So in the late 90s, the large cap stocks had really left everything else behind. Small cap stocks underperformed substantially from the mid 90s through early 2000, in large part due to the fact that those small cap companies couldn't afford the new technology and implement it into their businesses. And I think it's a really similar story today with these AI tools. The biggest companies that have brought us this technology did great for a couple of years, and the AI adoption is going to continue to grow. But just like with computers and the internet from 25 to 30 years ago, this really becomes a commodity, and it gets cheaper over time to the point that smaller companies, they can afford it. And even if it's a technology that's several generations old, they can still use it to make gains in their businesses and have it become a fundamental driver for their profitability growth. So long story short, small cap stocks are actually some of the strongest in this market. The setup there is as clean as you can find, and there appear to be fundamental, rational reasons for why this is happening. We're going to move on here, look at developed international stocks. They've also resumed their uptrend, although they remain about 3% below their former highs from late March. Now, this ratio between the S&P 500 and developed international stocks still appears to be rolling over, in my view. But as we said earlier, it certainly did bounce in favor of U.S. stocks in April. I really found this particularly surprising, though, given that the European continent, Asia, represents a lot of this index, and those companies and countries are much closer to the geopolitical action in Iran than we are here in the US. There have been numerous reports about countries coming close to running out of fuel, both auto and jet fuel. So these economies, they still have a lot to work through. So here we're looking at the relative performance of the S&P 500 versus the developed international stock index. And I've highlighted here in red all the periods where this ratio would have been in a downtrend over the last 25 years, which is to say that US stocks would have been underperforming their foreign counterparts. Cumulatively, it hasn't been often. And since the financial crisis back in '08, it's been exceedingly rare. But we've been on the lookout for a while that this ratio may change and start to move lower based on a number of factors. And starting valuations have certainly been at the top of that list. And if you've been with us for a while, you know that our perspective on large cap US stocks is that they're historically very expensive. Forward returns are likely to be well below average from these levels. Conversely, international stocks are much cheaper based on their historical metrics and likely to offer better forward returns. Now, I've mentioned in some of our prior updates and on our weekly YouTube show, The $1 Million Question, that the last time that foreign stocks consistently outperformed the US stock market was from 2000 to 2007. That followed a period from the late 90s when the prospect of buying anything other than US technology stocks almost seemed foolish. But alas, the fundamentals of lower starting valuations producing better forward returns over time led foreign stocks to substantially outpace the S&P from 2000 to 2007. And this happened during the Iraq War. So I feel compelled to remind everyone that despite the geopolitical turmoil of that era, international and emerging market stocks still managed to outperform the US consistently during that time. But there still were some windows of time, however, that lasted for maybe 6 months or so when you had a little counter trend move in this ratio. That was from mid 2002 up until the onset of the Iraq War in early 2003. So even though we could see a more persistent downtrend in this ratio where international stocks are outperforming as a primary trend, you could still have some periods of time where that ratio is going to move the other way. So we want to make sure as we're examining these intermarket trends that we sufficiently zoom out to make sure we're aligned with those primary intermarket trends. Let's move on to emerging markets here. I've said recently that this might be the most important chart in the world right now. Emerging markets breaking out above the pre-financial crisis highs in January of this year, came back to that former level of resistance, those 2007 highs, and those former highs appear to have turned into support. So if this continues to hold, which is likely the higher probability outcome, then this becomes very reminiscent of the secular breakout and retest that took place in the S&P back in the spring of 2013. Given the relative strength that we've seen in this category and their ability to hold this former high, we should now be betting that this marks the beginning of a new secular bull market for emerging market stocks. We're going to move on to commodities here. This asset class is definitely in an uptrend, but as we're challenging these former highs from 2022, these levels are probably a really good space to try to sell some and rebalance back to your target weighting. We first recommended that in March. Now, it would stand to reason that this index consolidates for a while beneath these former highs, but if and when it eclipses those levels, watch out. The pain at the pump would be getting pretty serious in that scenario in all likelihood. Now, we've also previewed that the rise in commodity prices that we've seen is still really yet to show up in the inflation data, but that is still coming down the pipe. So that might be a fly in the ointment for the Fed's ability to lower rates. And it seems like the market is really starting to sniff that out. Speaking of, let's look at the bond market. So we're still in an uptrend here for bonds, but barely. So the longer we see commodity prices, namely oil, remain elevated, the higher the likelihood that we see interest rates continue to climb and not fall. That would not be a good environment for bond prices. Now, while many Wall Street strategists have expected a series of rate cuts in 2026, by our view, we thought that there would really be no change. Our view, as we shared earlier, is really informed by looking at the yields on the front end of the Treasury curve. So the rate on the 12-month U.S. Treasury bill and the 2-year Treasury note, the Fed policy really tends to follow those rates around very closely. And currently, the yield on the 2-year note is around 3.9%, would suggest in the near future, we might be looking at a single interest rate increase before too long, not any cuts. I'd say maybe within the next 12 to 15 months. So much for Kevin Warwick being a yes man for President Trump. Time's going to tell. Ultimately, the front end of the yield curve is going to be the tell. Here we're going to end this portion of our review. If you're looking at the public portion of the review, looking at REITs, so the Dow Jones Equity REIT Index, it had broken out above some of those former highs in late February, early March, but that was very short-lived. But then with this rebound we've seen in April, we're back above those former highs. So they're in an uptrend, but this has certainly been a volatile period for the REIT space over the last couple of months. But the longer we can hold above those former highs is a very constructive outcome for the real estate market.
Thanks, Stephen, for taking us through the review this month. So to recap, markets rebounded sharply in April, led by technology stocks, bringing major indices back into positive territory for the year. Inflation pressures are building, driven by higher energy and commodity prices, and are likely to show up more clearly in the months ahead. The Federal Reserve held rates steady, but growing internal disagreement and bond market signals suggest that rates may move higher, not lower. Across equities, U.S. large, mid, and small caps are all in uptrends, with improving opportunities in small caps and international markets. Emerging markets may be entering a new long-term growth cycle after breaking above key historical levels. Commodities remain strong, supporting diversification in portfolios, but also reinforcing inflation risks. In fixed income, we favor short duration and income-oriented sectors while remaining cautious on interest rate sensitivity. Despite historical seasonal headwinds, we believe that investors should be nearly fully invested at this time. So with that, I'm going to turn it over to Stephen for some final thoughts.
All right. Thanks so much for joining us here for our April review. I hope you found it insightful. As always, if you have questions, feel free to send us an email to info@reveillewealth.com. Hope everybody has a great end to the school year and enjoys your summer, and we'll look forward to catching up with you next month. Take care.